Well, Kenya needs faster and more inclusive growth if it is to attain economic growth rates of between 5 and 6%. According to Razia Khan, Standard Chartered Bank's chief economist for Africa, Kenya's debt levels are teetering on the brink, a trend that could cause a slowdown in economic activity. Here's more on that update.
Kenya's economy has been stable for the last few years, growing at about 5% on average. And despite hitting a high of 8.01% in December, inflation has largely been range-bound. On the other hand, the shilling has been taking a beating, depreciating by about 12% in 2015. Even worse, analysts say the debt levels could be getting out of hand.
With a rising public debt ratio, Kenya is not going to be able to afford a situation where real GDP growth does not continue to go up over time.
The interest paid on Kenya's domestic debt rose by 8% in the first quarter of 2015 compared to a similar period in 2014, reflecting the effect of higher interest rates on treasury bonds and bills. Domestic debt stock comprising of government securities and overdraft facilities has grown from 1.38 trillion shillings as at the end of September to 1.53 trillion shillings currently.
There has been a rise in external financing because it has been cheaper, because it has been required to finance a lot of what was happening with infrastructure.
These sluggish export volumes have also remained dull, presenting a lukewarm business climate for foreign investors. As a result, a number of firms have bolted, leaving the export sector reeling and piling pressure on Kenya's borrowing position.
And Kenya would do better to focus on much more of an export-driven program, much more to think about external competitiveness to try to reassure on this front.
For now, the outlook is a mixed bag of fortunes, with global oil prices on the decline and inflation expected to fall. Abiyagina, KTN Business.